Great pleasure now to bring on board Mr. Dinesh Kumar Khara, Chairman of State Bank of India. And I've always maintained that it doesn't matter what is happening in the world. Every time when we get Mr. Khara, he convinces us that there is light at the end of the tunnel. It is reason to stay optimistic. And he's got this uncanny art of really looking through the bad news and still identifying the good news. So Mr. Khara, it's a day when we are dealing with something called equity market sell-off, concerns of slowdown in the world, and crisis on inflation management. Where is the good news, sir? Today an optimist like you will also struggle.
Thanks, Nikunj. I think, well, of course, I think one has to be realistic. It is not a good news or bad news. We have to find the way how to navigate even the bad situations also. So what you mentioned in terms of the global stock prices are down and all that stuff. Well, of course, I think this is, all the markets are sort of reacting to the global situation. But if at all we will look into in greater details, we will observe that, as far as India as an economy is concerned, we have got an economy which is actually dependent on its own resources. It has got its own demand. And we have got a huge demand which remains unsatisfied even now. So, of course, we cannot perceive ourselves to be insulated from the global trends, but nevertheless, to a great extent, we can actually depend upon our own strengths also. So, I think from that point of view, I still believe that maybe global stock market movement might have some impact for a day or two, but eventually even the investors will be in a position to see where is the merit and what is the kind of a demand which the companies will see, and how it is going to overall impact their performance. That is something which I believe is one of the key component for any investor to take a call relating to the stock market or the market prices of the stocks are concerned.
Mr. Khara always identifying the silver lining in the dark clouds. But Mr. Khara, just to pick up your point further, I don't know if it's too early to really get into these kind of discussions, but are you already seeing early signs of, say, change in trends for consumption trends when it comes to retail loans, credit card spends, etc.? Retail loans.
So what last 1 month or plus, almost about for the current financial year, we have seen that there's as far as demand for the retail loans are concerned, it has remained intact. And similarly, even the credit card spends also, we are not seeing any adverse trends. So I would say that, of course, when it comes to the geopolitical situation and its impact on the imported inflation component which we have, more so in the crude oil and also edible oils, that I think we'll have to live with for the time being. And if at all these two very important components gets addressed, which I would say that has not really had a very significant impact on the demand as of now. So I would overall say that the way situation stands, we don't see any challenge in the demand, and rather I would say that since the capacity utilization has improved, it is rather a function of an improved demand and also some kind of a certainty in the market or certainty in terms of the cash flows. That's why there is a demand. So that is what my reading is.
Are you also seeing a demand pickup in term loans? Last time when we spoke, you had mentioned that you are seeing green shoots, but has those green shoots now translated into a trend about term loan demand by corporates?
Yeah, we have seen the availment of the term loans which was sanctioned as at the end of the previous quarter, which was ending December. March quarter, we have seen the definite traction, and even beyond also, we are seeing that there is a demand for the term loan, and also the availment has also started happening. So it is actually, I would say, fairly broad base. It starts from renewable energies to airport to infrastructure relating to ports, and so I think it was essentially, as of now, it is I would say core sector and also the infrastructure sector, which is showing some positive trends.
So if I look at the combination of higher working capital demand, which is because of high inflationary uptick, and term loan where availment has started, a double-digit credit growth is something which should be an easy watermark for SBI to achieve.
We are aspiring for having a double-digit growth in the credit rates.
Mr.
And
Khara,
also, I would also like to mention that yeah, please. Yeah, Nikunj.
no, sir, there is a delay. Please finish your point.
No, I was saying that we have started seeing better utilization of the working capital facilities which I have already sanctioned. So overall, that used to be underutilized, unutilized capacities were as high as about 50% as far as the working capital facilities were concerned. So now it has come down to somewhere around 45%. So which means that there is a clear improvement in the working capital utilization, and which is what you mentioned partly could be on account of the inflationary impact also. But nevertheless, I think it is a significant improvement as compared to the trend which you have seen in the past.
Let's talk about the pocket, sir, where you now have complete domination. You're the largest, home lender brand or franchise. While we may argue that the corporate demand and for other sectors, a little bit of uptick in interest rates may not be demand destructive. But do you think the same may not apply for the housing market? Because this is a market which is very sensitive. A, real estate prices have gone higher. B, if interest rates they go higher, this in a sense will start raising question mark on the affordability.
I look at it from a little different lens, and that is essentially linked to the EMI versus NMI, which is equated monthly installment versus the net monthly income. If at all net monthly income goes up, then perhaps as far as the home loan demand is concerned for the first time home buyers, I don't think it will get impacted. It is only for the investment purposes. If at all people are investing into homes for the purpose of investment, it might get impacted. But as far as the home loan for the first time buyers, I don't expect any change. And for us in State Bank of India, the way our home loan portfolio is stacked up, it is actually majorly the first time home buyers, and also I don't expect much of an impact. And the kind of trends which we have seen for last about 2 months plus, that is a very clear reflection that so long as people have the ability to service the loan, they don't mind raising the loan. And normally in the inflationary conditions, it perhaps make ample sense to invest into the assets, and that too with a leverage, because that also actually helps in creating economic value for the borrowers.
Good morning, Mr. Khara. So if you see the recently declared earnings, the corporate book higher by 11%, more than 5% loan growth seen as far as the retail book goes. My question is very, very basic actually. With all this bad news that's coming in, whether it is inflation or, slowdown being indicated by the bond markets, you have said demand remains robust, but can it continue to remain as robust? Will companies scale back? And in bad times, they generally don't like to expand. Will that impact the books?
I had made some rough calculation and could arrive at this, I was trying to see that what is the interest cost in the overall stack of cost for any entity. So I could figure out that it actually varies from 8% of the total cost to 15% depending upon the leverage which people have raised. So there are two components to it now. When it comes to corporates, they have deleveraged them quite a lot in the last about 2 years' time. So they have got a ability to raise loan on their balance sheet. That is one. And secondly, they have got adequate internal accruals too. So if at all they will have a visibility of the demand, I don't think that it will be holding them back in terms of investing into the capacity. And inflation, of course, is something which is a concern for all. But I expect, the way I read the inflation, we don't have a situation of the capacity constraint. So essentially the supply chain disruption which has happened is essentially on account of the global situation. So I think if at all the global situation gets addressed, maybe I hope that maybe by in the first half we should see some kind of a improvement in that. If at all we are in a position to see that improvement, I'm sure the monster of inflation will perhaps be tackled. This is what my understanding is, because as far as capacity utilization, there is ample capacity. Supply chain disruptions, if at all they get addressed, particularly from the geopolitical angle, perhaps we will not have much of a challenge. And the way we had seen the traction in the last quarter of the previous year and even from the third quarter onwards, I expect a similar kind of a demand resurfacing, or maybe even stronger demand might be seen.
And Mr. Khara, this is obviously after factoring in more rate hikes. As we know, we go back to the normalized rate cycle in the post-COVID world. There are leading experts that are saying that in the June policy, when the RBI comes out with its inflation forecast, it could be maybe with as high as a 50 basis point rate hike.
I think these are some of the macro variables which we probably cannot visualize in advance, and RBI will also be consuming a lot of information which would be available to them before they will be taking any decision. But nevertheless, I think the skill of a banker and lies in navigating the difficult situations quite comfortably. So as a system, we have demonstrated during the period of the COVID also that all banks have come out very, very successfully with handling the situation. So I hope our skill will help us in navigating this situation also, and also inflation related and the inflation related impact on the policy perhaps should not be for. I expect that maybe if at all, if the geopolitical situation gets addressed and if at all inflation is tamed by the second half, perhaps we'll have better situations to really navigate.
There is going to be an impact on the treasury portfolio of State Bank of India given where the bond yields are moving. How large could that impact be?
No, there is, of course, in the past when we have seen the situation where the credit growth was not happening, we had tried to diversify our trading portfolio also. And the recent, annually we are permitted to move securities from HTM to AFS. That also we have done. So we are adopting all possible tools which can help us in minimizing its impact on the earnings of the bank.
Can I say that the impact of treasury portfolio because of higher interest rates in the first phase will get nullified because your NIMs will improve in the first phase of interest rate cycle? Just for the benefit of our viewers, Mr. Khara, what happens when, I'm just putting this point just for the benefit of our viewers, that what happens is that banks will enjoy a greater spread when interest rates they start rising. Now my question, sir, will both of them just cancel out?
Well, I think when it comes to the loan book versus the treasury book, our and also particularly AFS would be about 5 trillion for us. And if we look at our loan book, almost about 74% of that book is linked to either MCLR or to the EBLR or the treasury bills. So normally, if the MCLR, EBLR, and the T-bill will have a tendency to really move up. So that will also give us better NIM also, and also better NII. And at the same time, it will also, if with the kind of a loan book growth which you will see, we'll have a situation where part of the AFS will be in a position to deploy in a much better asset, yielding assets also. So that will also help us in augmenting our earning. So overall, I would say that we are quite hopeful that we should be in a position to address any adverse impact of the yields on the treasury book through these mechanisms. And also, I think maybe we will also see that even if at all some rebalancing could be possible in the treasury book, even that also will be attempted. So efforts will be made to ensure that we insulate the bank's overall balance sheet from any such shock also.
Mr. Khara, I'm curious to know, when do we hear the SBI MF listing, or is it going to get delayed for a better market perhaps?
It's an asset which we have nurtured in the past very well. So we are waiting for the right and opportune time. So we would like to see that it fetches the right value. That is what is the consideration. So the variable relating to it should fetch the right value will be a function of how the markets will be. So we'll wait for the right opportune time. We are otherwise in readiness.
Good to hear that. The other thing, Mr. Khara, I wanted to understand is, given the kind of consolidation that we are seeing, especially in the private banking space, given the kind of domination that you have in the banking space, where big is only getting bigger, especially in this kind of a demand scenario, wanted to understand what happens to smaller banks. And do they become takeover targets? And are we going to see further and further consolidation play out within the entire banking sector?
See, typically speaking, the way banking sector operates, it has to deal with the risk. It has to have strong capital base, and it has to have the requisite skills for managing the kind of challenges which are posed by the macro, domestic as well as international. So in that context, perhaps there could be a scope majorly for the large banks. Having said that, I would not like to discount the fact that there is always a room for the smaller banks too, because they are the niche market players, and there are ample opportunities which exist in the niche market too. So to my mind, there is a room for coexistence of both the kind of banks, bigger as well as smaller. But smaller perhaps cannot get into the activity which the bigger banks are entering into. Smaller will have to find their own niche and will have to see that how best they can create value for their stakeholders. So I think, to my mind, there is a room for existence of both large as well as small.
Mr. Khara, before we wrap, and I'm just trying to maximize our today's interaction. Every quarter, sir, when we've interacted, you've said that, look, you are working on taking the ROA higher and bringing the total costs to income ratio under check. What is the update? And given that we've got so much of pull and push because of inflation, demand, and so many variable factors, will things move as per planned, as per indicated by you?
Yeah, I think the way we have moved in the current financial year also, we have moved towards 0.67 as far as ROA is concerned. So our guidance which we had given at early stage when I had assumed office as a chairman, I had indicated that we will strive for achieving ROA of 1 by the year 2024. So I think I would say that till now, whatever we have achieved is better than what we had and what we had planned for. And as far as the cost to income ratio is concerned, there is a small improvement which has happened. But for that, I have been maintaining that there are some, there are certain rigidities in the cost structure. So that is something which we are trying to address. And with that in mind, we have already gone to our board and also to RBI for seeking approval for setting up a operational support subsidiary, which will help us in optimally utilizing our field forces, and they will be in a position to generate more towards more and more revenue for the bank. So once cost part will really tackle by seeing that our income part goes up, and once the income goes up, our cost to income ratio matrix also will even look better. So I've been saying that we will try to bring down our cost to income ratio below 50, and that is our effort and endeavor. And we are already working in that direction. Now it is a work in process, which I would say, in terms of bringing in the structural changes.
Just to get it right, that your ROA guidance of 1% plus for FY24, that is intact.
Yes, absolutely.
Okay. Couple of follow-up questions, Mr. Khara. The economy is expanding and the demand for credit is coming back. What is happening to your market share, or what has happened to your market share in last 12 months?
As far as our advances and deposit market share is concerned, it is deposit is somewhere around 22-23% and advances remained around 20%. So it has remained as it was in the past.
Confident you will be able to maintain these market shares, because market share ultimately will be an indicator of future profitability?
I agree, and I think when it comes to the market share, I would say that we have, of course, we had the plus of our physical distribution network, but we have significantly invested into the digital also. And not only digital as a vehicle, but also we are leveraging analytics, and that is something which has started yielding results. And in the last financial year, we have seen a decent traction. We are in a position to reach out to the customers based on our analytical engines, and it has helped in fulfilling the customers' demand in a timely manner and in the most appropriate manner. So I think we are actually investing into the digital muscles of the bank. Apart from that, analytics is something new which we have started really sweating for last about a year plus, and we are seeing the positive results out of that. We are actually leveraging it not only for business purposes, we are leveraging analytics even for the risk management and even for optimizing our operations also.
Perhaps, sir, I must say that when State Bank of India chairman is using words like digital assets, AI, sweating your assets, you're sounding like a startup, and that's like the big change in terms of the moot point in the whole approach of State Bank of India. So my final question, Mr. Khara, is that every time interest rates they go higher, markets and shareholders they start worrying about NPAs, they start worrying about delinquency. Do you think we are very far away from any cycle reversal, any NPA problems, at least for next 2 to 3 years? Because अभी तो नई cycle चालू हुई है.
Nikunji, what we have done, and we had significantly strengthened our underwriting practices for last about 4 years plus, and the net result of that is that we are in a position to assess the risk much better, and we are in a position to put the mitigants also in place. So apart from that, if at all there is any stress, because stress cannot be ignored or avoided, or so that is the reason why, if at all any stress is seen on the ground, as a matter of policy, we ensure that we should provide for the stress even before it really hits the balance sheet. So I would rather go to the extent of saying that we provide even before the slippages happens. So there is normally people link up with the slippages with the subsequent provisions, but in our case, we have got a situation where we start providing even before the slippages are reckoned. So, which means that earliest sign of stress is also being very carefully monitored and appropriate actions are taken to insulate the balance sheet from any future shock. So, that is something which we have done. So, having said that, I am quite confident that our underwriting practices plus our policy in terms of adequately providing for any stress in the balance sheet or the likely stress in the balance sheet should see us through quite comfortably even when the cycle has just started reversing.
Okay, Mr. Khara, we're going to leave it at that. Thank you so much for joining us live today on this edition of the market, and of course being so candid, not just the earnings fine print, but going ahead, the guidance particularly on the ROE and what you make of the macros and the banking space at large. Many thanks once again.